Hello guys, welcome to the next episode of the Birdnest Weekend Charting School. This is Huddle today, and I will present to you the 9th episode, which is the second episode of chart patterns. In episode 7 of the Weekend Charting School, we covered reversal patterns, and today we'll take a look into continuation patterns. So today we will be covering continuation patterns. First, I'll do a short introduction about these before we'll take a look at the pattern itself. Today you will learn about the following patterns: the symmetrical triangle, the ascending triangle, the descending triangle, flags and pennants, the wedge formation, the rectangle formation, the head and shoulders as continuation pattern, a summary, and some credits. So actually this episode is the second part of chart patterns. We've looked before into the reversal patterns, and today we'll take a look at continuation patterns. In short, the continuation patterns can be described as a short pause within a down or uptrend of an asset. One of the differences between this pattern and the reversal pattern is their time duration. Reversal patterns take much longer to build and represent major trend changes, while continuation patterns are shorter in duration and are intermediate patterns. All patterns we'll be covering today are continuation patterns, but there are some exceptions, while some of the patterns could also act as reversal pattern. For example, a triangle can also occur as reversal, but in general, consider the patterns we'll be looking today as continuation patterns. Now let's take a look at the first pattern, the triangle. The first pattern we're looking at, triangle, consists of 3 types. Now just take a few seconds to look at the 3 patterns below, because I'm pretty sure you've seen them in some chart analysis. We'll start with the symmetrical triangle, which is the image in the center of the slide. One of the most obvious things to spot here are the 2 converging trend lines. The symmetrical triangle, as said, is a continuation pattern and can be seen as a pause within a bearish or bullish trend. When the main trend is upwards, it's usually a bullish continuation, and on the other hand, if the main trend is downwards, the pattern is called a bearish continuation. Now, the 2 converging lines do need a minimal of 4 touches on the trend line, both 2 on each line. But it's common we see more, for example 6 touches before a break above or below these lines. Now remember that at the point where the 2 trend lines are the most far away from each other, this is called the base. The point where the trend lines meet is called the apex. Now, because of the symmetrical trend lines narrowing, we could say that there's a moment in time that both trend lines cross. So basically, there's a time limit for price to break above or below the trend line in order to be valid as a symmetrical triangle. It is said that on average the breakout is at 2/3 of the triangle. When taking a better look at the image on the right side of the chart, it's easy to spot that there's difference between A and B in price. This is called the base, and that the touches of the upper trend line are lower highs and the touches of the lower trend line are higher lows. When price breaks out of the symmetrical triangle and closes above or below, the pattern is completed. As within every continuation or reversal pattern, the volume profile is extremely important to watch. In this pattern, the volume should burst on a breakout of the triangle. A return move back to the triangle, as within this image, should be on light volume. The symmetrical triangle gives us a good indication of where price will be headed after a successful breakout. By measuring the difference in price on the base and plussing this price difference vertically where price breaks out of the triangle. For example, is the base a $300 difference? Our target is $300 up from the moment of breakout. Now that we've covered the symmetrical triangle, let's take a look at the ascending triangle. The ascending triangle is the second triangle we're covering today. Here, the center image on the slide shows a flat horizontal upper line and a rising lower trend line. This is how an ascending triangle looks like. The ascending triangle can be seen as a bullish pattern and is just a variation on the symmetrical triangle. In this pattern, buyers are more aggressive compared to sellers, which results in equal highs creating the flat horizontal resistance and 3 higher lows. As within the symmetrical triangle, you can spot the base and the apex in the same way. Also, this pattern has a time limit, the price will make a decision before the trend lines meet each other. When we get a decisive close above the trend line, we could state that the pattern is completed. With all breakouts, the volume profile must match up with the move. So in this example here, when price breaks above the flat horizontal, volume must see a burst to be a valid pattern. Lack of volume, the price could fake out above the trend line. And just as with the symmetrical triangle, by measuring the base, you could have an idea of where price will move after a breakout. One last thing to add on the ascending triangle, there is a possibility that they occur as reversal pattern on market bottoms. But as said before, more common is that it's a continuation pattern. Here we will cover the latest triangle, the descending triangle. It's the opposite of the ascending triangle, and it's easy to see here on the image that it has a flat horizontal bottom trend line and a declining upper line. Important to remember is that the descending triangle is a bearish continuation pattern. This last triangle in the series, the descending triangle, is most of the times a bearish continuation pattern, and again it's a variation on the neutral symmetrical triangle. The bears have control over the bulls, meaning that sellers exceed the buyers. And just as the symmetrical triangle and the ascending triangle, this pattern again has a base, an apex, and therefore is time limited. Now, when taking a look at the chart, it's easy to spot the declining upper trend line and some horizontal support. After a few touches on its support, or the flat bottom, bulls give up and bears take over control. Price will close below. This will take place with a burst in volume to complete the pattern. And again, by measuring the base, you get a clear picture where your take profit area will be. The descending triangle will occur within a downtrend and therefore is bearish, being a pause in the downtrend. But there are exceptions. While this pattern could also appear as a reversal pattern at the market top. Now that we've discussed all three types of the triangle, we're going to take a look at the flags and pennants. Flags and pennants are one of the most reliable continuation patterns. On the images on the right, we'll see a bullish flag and a bullish pennant. One of the most obvious things to spot here is that the flag and the pennant occur after price has made a very sharp move, in this case to the upside. The sharp move happens with a burst in volume. So just as with all other patterns, volume again is something to take a good look at. Now on triangles we've talked about the base and the apex. With flags and pennants we're talking about flag poles. The flag pole is the sharp up or down move in this pattern. With this flag pole we are able to measure the price objective after we break out of the flag or the pennant. In general, the move after the trend has resumed will duplicate the flag pole or the move just prior to the formation of the pattern. Again, price is measured from the breakout point of the flag or pennant. Something to remember that with these patterns is that the flag and the pennant are both preceded by an almost straight line, which we call the flag pole. Then, when the pause kicks in, this is where the price forms the flag or the pennant, and the trend will continue only after a burst in trading volume. Both of these patterns occur at about the midpoint of the market move. The pennant could be easily seen as a symmetrical triangle, while it makes higher lows and lower highs with two converging trend lines. Important to add before we move on the next continuation pattern is that these patterns develop much faster in downtrends compared to uptrends. The wedge formation, also known as falling wedges or rising wedges. On this slide you could clearly see the difference between the two wedges. Both have two converging trend lines with multiple touches on the trend line. But the big difference here is that the rising wedge occurs in a downtrend while the falling wedge occurs in an uptrend. So actually, within a rising wedge, price rises against the downtrend and price will decline against trend in a falling wedge. While usually these patterns could be classified as continuation patterns, there again is an exception to be made. Sometimes this pattern will occur at the end of an up or downtrend. The rising wedge therefore will be a reversal pattern when the uptrend comes to an end. And the falling wedge on the other hand will be a reversal pattern where the downtrend comes to an end. The rectangle formation is a pause in an up or downtrend where price will mostly go sideways. Most of the time you'll hear traders about consolidation or trading range. It doesn't matter as long as you remember that the price moves back and forth between the upper and the lower flat line. After a few touches on these trend lines, price will continue in the direction where it came from. So, on the images on the right, you'll see that we talk about a bearish rectangle when the main trend is down and a bullish rectangle when the main trend is up. On this chart on the right, it's easier to see the rectangle. Price trades within a clear range. Therefore, it's relatively easy to swing trade this pattern on the intermediate time frames. The pattern is only completed when there's a break above or below the trend line, accompanied with a burst in volume and price doesn't move back below. Take profit area can easily be measured by the price difference between the horizontal support and resistances. Now we've come to the last continuation pattern in this episode, the head and shoulders. If you've seen episode 7 of the Weekend Charting School and studied the head and shoulders pattern, then you'll be surprised that we come up with this pattern again, while we stated that the head and shoulders is mainly a reversal pattern. But again, there's an exception on everything in trading. The head and shoulders could also appear as a continuation pattern during up or downtrends. The images on the slide show you that the bearish head and shoulders appears in a downtrend. There's a clear high, which is the head, and a lower high on each side being the shoulder. Breaking below the neckline completes the pattern and the price will move down further. On the image on the right, there's an inverse head and shoulders to be spotted, and this one occurs in an uptrend. Make a horizontal resistance which moves slightly down and create a low and a higher low on each side of the head. Price moves up on after. Sometimes it's hard to spot these, while one could easily be mistaken with drawing a rectangle on this. So now that we've come to an end of this Weekend Charting School, here's a short summary. 4 points to remember. The continuation patterns are pauses in trends, up or down trends. Patterns are easy to recognize, but you should practice on charts, because on charts it's much more difficult. The volume profile again is extremely important, but more important in uptrends. Breakouts should come with a burst in volume, and the patterns develop faster in downtrends. All knowledge shared in this episode came from John G. Murphy, writer of the book Technical Analysis of the Financial Markets. Now guys, thanks for watching this next episode of the Weekend Charting School, and as always, it is extremely important for us that you'll subscribe to our YouTube platform and follow the main Twitter account of Crypto Burp and the Burp Nest. We thank you in advance, and I'm extremely grateful for having you guys and girls in our community. Now, to conclude, I'd like you to take a look at our website at www.theburpnest.com. We've updated our prices for all packages and will continue to share great articles on our Nest Medium account, and we'll utilize YouTube more often with live streams during great price action. I hope you've enjoyed today's episode of the Weekend Charting School, and I hope you to see again in the next episode. Thanks for watching, guys.